Hello and welcome to the COL Strategic Fund's third quarter 2025 update. I'm Zerge Zandueta, Portfolio Manager for the COL Strategic Growth Fund. The third quarter proved difficult for Philippine equities. The market lagged regional peers, weighed down not only by the recent corruption headlines, but also by weak corporate earnings, which disappointed expectations. Even as other emerging markets benefited from global monetary easing, investor sentiment towards the Philippines stayed cautious and liquidity light, leaving the local market one of the region's underperformers. Against this backdrop, the CSG fund fell 4.7% for the quarter, still outperforming the PSEI's negative 6.5% decline. Year to date, the fund is just down 1.4% versus negative 8.8% for the PSEI, highlighting our disciplined risk management. We continue to deliver on our goal of reducing downside volatility while maintaining exposure to long-term equity growth. The quarter also brought significant global policy shifts. After a year of holding steady, the US Federal Reserve finally cut rates, while the BSP delivered two successive rate cuts, bringing local policy rates down to 5%. This led to lower yields across bonds, but the peso also weakened slightly as governance concerns and corruption investigations clouded sentiment. Nonetheless, these moves mark the start of a new monetary easing cycle that could provide a supportive backdrop in the quarters ahead. During the third quarter pullback, we took advantage of lower prices to increase equity exposure, bringing the portfolio to roughly 73% equities and 27% fixed income. We selectively deployed capital into high-quality banks, power, and telco names, where earnings resilience and dividends remain strong. Fixed income holdings in short-duration government securities and money market funds continue to anchor the portfolio and provide liquidity to reinvest as opportunities arise. Looking forward, we see scope for a mean reversion rally. Last year, the PSEI staged a 24% rebound around the time of the Fed's first rate cut. A similar move could happen again, albeit delayed, as easing policies filter through and sentiment improves. With valuations now attractive and positioning light, the ingredients for a recovery are in place. Historically, when the Fed begins an easing cycle without a US recession, emerging markets have been the best performing asset class, averaging 24 returns also 1 year after the first cut. The Philippines stands to benefit from this pattern. In fact, we are already seeing positive signals, such as a rise in corporate share buybacks and moderation in foreign selling, both early signs of renewed confidence. Technically, the PSEI is trading near the bottom of its multi-year range between 5,800 and 7,600, levels that have historically provided strong support. Valuations are at decade-low levels as well, around 9.7 times 2025 earnings, with dividend yields above 3%, offering both value and carry while investors wait for catalysts. This combo of low valuations and solid yield support gives us confidence to remain invested and ready to add selectively. That said, we continue to monitor key risks. First, persistent weakness in corporate earnings that could temper recovery and momentum. Next is a slowing economy as government spending stalls under scrutiny from all of these corruption probes. And third, tariff and trade uncertainties could still ripple through with effects on inflation, exports, and manufacturing jobs. These risks reinforce the need for flexibility and active management, key elements of how we run the CSG fund. In summary, while challenges remain, we believe this environment offers compelling long-term entry points. We stay selective, disciplined, and constructive, positioning the fund for opportunity amidst all this volatility. Thank you for your continued trust and partnership, and may you have a good quarter ahead.